Hey there, here's what's happening in the news. Today on RTD News Update, I want to share with you some thoughts on recent Federal Reserve forecasting and plans and readjustments and slashing of GDP and things like that. So today's article has to do a lot with just the recent statements and viewpoints based upon the Fed, once again not hiking interest rates and their forecast that they probably won't be doing such until 2017, which at that point we might have some type of event which will cause us to have to go negative. So here's an article from CNBC where it talks about Federal Reserve Bank guy Dennis Lockhart, the president and chief executive of Federal Reserve Atlanta, basically just talks about just the GDP and how the anticipated numbers were expected to be a lot higher than what they turned out to be, which kind of plays into the idea that just one reason why they decided not to hike rates and things like that. And so he gives a lot of figures here and projections and things like that. But ultimately, when you scroll down to the end, it says, despite the fairly positive FOMC language, particularly on the labor market, traders anticipate only a slightly higher chance of a rate hike in 2016 than they did before the meeting. The Fed funds futures market now indicates a 24% chance of an increase at the September Fed meeting and a 50.5% chance of a move by year's end. So once again, it's amazing how they're basically stringing people along as into thinking they can actually raise the rates. So it's comical to think that people actually believe that they're going to be raising the rates back up to what will be considered normal, knowing that that would just make everything implode. So just a little, mainstream news, something to laugh at. Here's the next one. Dollar bulls tremble as Fed hike bets push deeper into 2017. And so the first article said 2016, 50%, 50.5% chance by December. Here's one from Bloomberg that says that 2017 is going to be the anticipated rate hike. And so this article here deals with just the whole idea of the dollar in between now and then. Now, a lot of investors are concerned over the strength of the dollar and things like that, and a lot of statistics about the Bloomberg dollar gauge rose 0.2%, and just comparing the dollar to the strength of other currencies and things like that. And then what I found interesting was how it's a warning path. It says Morgan Stanley warned the worst is still to come for the greenback as the economy deteriorates. And so the dollar strengthened in early July is stronger than expected data on jobs, retail sales, and industrial production, fueled speculation that Fed would raise rates sooner than later. Investors' focus is set to turn the payroll data to release on August 5th for clues on the state of the economy and the pace of the Fed tightening. So just, more, for the most part, nonsense on just all these, anticipated rate hikes. Can't do it. Can't do it. Something to check out for yourself if you're interested. The next one, Fed's Dudley urges caution on rate hikes, cites risks to U.S. So we have another Fed guy. We have Fed Dudley. We had the other Fed guy. So all these Fed people are coming out with just, different types of statements on whether or not they can tighten or not, and whether or not they will tighten. And it's just basically just driving the public in circles for the most part. But here are all three of the reasons evidence the U.S. monetary policy is currently only moderately accommodative. The fact that the U.S. financial conditions have been influenced by economic and financial market developments abroad, and the risk, yada, yada, yada. This guy just rambling on, saying a whole lot of nothing. But just, more information for you to check out. I mean, the whole point of this is they're going to talk and talk and talk about raising rates and when and how and all that stuff like that based upon, forward guidance and market stuff like that. But, markets aren't going anywhere. Another one, FOMC Butterfly that will ruin the world. So I thought this article was quite interesting because this writer here talks about, some of the market or data dependent things that the Fed uses to kind of gauge as to whether or not they can actually make adjustments. And so here they actually list and give you a couple things to look at. And one on being core CPI. The goal, of course, for central banking is 2% target inflation. So whenever it's in the green, I mean, they're nowhere near the target. When it's in the red, that means they're, at or above. And so actually inflation, hurts the, population, but, that's not important, I guess. Unemployment, FOMC estimate as opposed to what's actuality. And so right now, unemployment is down. So I guess that's a good thing. Here we have real GDP versus Fed estimate of potential GDP. And so we're in the red, so that's obviously a good thing according to them. But at the very end of this article here, he lays out his claim. The Fed has painted themselves so far into a corner that they cannot avoid stepping on some wet paint soon. A symbolic 25 basis point hike in December and financial Armageddon seems to follow. Commodity prices crashed as the global dollar funding dried up. Capital outflow from emerging markets became an acute problem. That is why, despite all the data dependence, the Fed is unable to follow through on their incessant threats to raise rates. The house of cards built on continuation of ample dollar flows at low rates is too fragile to withstand even the slightest disruption, such as a insignificant 25 basis points. So basically saying that, it's not going to happen. There's no rate hike coming no time soon. And then I thought this article here from Mauldin Economics was quite interesting, where John Mauldin, famous economist / investor, basically just shares his thoughts. The Fed is preparing for negative rates. Here's the signs everyone missed. So this article here he talks about in during a congressional testimony, Janet Yellen basically hinted at the idea that the negative rates was something that it's not been talked about, but it's a concept worth looking into. And so he actually goes through 3 of her prior statements or whatnot, where she actually hinted at, as of February, Yellen had not fully investigated the legal issues of negative rates. And then in May, Yellen was unwilling to state that the Fed had legal authority to go negative. And as of June, Yellen had no doubt the Fed could could go negative rather. So anyway, so this is just a quick synopsis of his take on how, in his prediction, the ultimate goal will be negative, because everyone around us, the Bank of Japan and a lot of European countries, they're all negative. So there's no way that the Fed, being the leading monetary central bank, can actually go positive and it'd be good for everybody. So there's no chance whatsoever that they actually increase rates anytime soon, but instead go negative. And then talked about, in the case of another recession, which, some of my prior guests on RTD interviews have said we're already in a recession. But yet, if it's official and it's known that we are in a recession, then what? You really can't go positive. You have to go negative. So the end of all this equals negative rates coming from the Fed, just a matter of when. And I believe, in my opinion, that it'll be sometime, 2017-ish. And so to end this up, here's a report from Reuters. Selling everything, double lines, Gundlach says. So anyway, this guy here is a $1 billion investor from DoubleLine Capital, and he talks about why, as an investor in capital management fund hedge guy, how he's basically just not very optimistic on the economy, and how he's basically dumping everything and betting on gold and gold stocks. So here's another guy, another top line investor, who's basically coming public and saying that the data isn't really adding up for what's happening with the S&P 500 and all the other stock related investments. And so he's basically saying that he's not betting against treasuries, but he's not really looking forward to getting much from them. So he's gonna hold a lot of his stuff in gold and in gold stocks. And so just another take from someone who's well invested into the financial markets. And then to finish up, Daily Reckoning, Mr. James Rickards. Here's one on silver. And so he does a good job of basically painting a history of the role of silver and how it's always been right up there with gold. And everyone who knows James Rickards, he's a big $10,000 an ounce, someday in the future gold man. And so he's basically saying that, right now is the time to bet on silver as well. So he actually gives a formula that kind of plays into why he is now encouraging silver. So it's the intelligence triggers and some Bayes theorem from 19th century formula, first discovered by Thomas Bayes. So it basically just breaks down how it operates and how the calculations pretty much say that we estimate a 60% probability that the price of silver will increase at least 25% in the next 6 months. And then he goes on to list, a couple of reasons why that could be. And so other than that, James Rickards, who's a big gold guy, is now promoting silver. And so silver being a lot more affordable may be something worthwhile. But anyway, this is what's happening in RTD News. Hope you enjoyed it. Subscribe and share it if you find it informative. Also, check out the links below for more details and for you to read it for yourself so you can see what's what and get a better understanding for yourself. So looking forward to bringing you more RTD news. Until next time, peace.